Pending home sales in the U.S. hits a 22-year low, while the affordability index hits another all-time high, and people are wondering, when is this housing market going to shift? Mortgage rates dipped slightly, and Freddie Mac has a brand new second mortgage approved by the Biden administration that many investors are thinking this is subprime lending coming back. I'm Chris Lamb. I'm a 22-year mortgage lender in most states and a real estate investor. My goal is simple. I want to help the middle class get out of the rat race through legacy wealth, through education, and common sense. Before I jump in, please make sure to like, subscribe, or leave a comment. I do get back to those. You can ask a question, and I'd love to hear what you have to say. The National Association of Realtors recently put out an article that pending home sales hit its lowest level since 2001. Now, this is pretty crazy if you think about how big our population is, and that home prices have not gone down. In fact, in the same month, there was an article that came out that showed that the affordability index, which takes into consideration things like home prices, interest rates, and the cost of owning a home, hit another all-time high. It had already hit an all-time high just a few months back, and it's still going up. So many people are looking at this housing market thinking, gosh, man, something's got to give. And the reason why we haven't seen the housing market simply crash is because of what we're calling the locked-in effect. When you have so many would-be home sellers that have a 3 or 4% mortgage or less who are simply living in their property, they would like to buy another property. Their lifestyle has changed. They have more needs. Their family's getting bigger. But when they think about the rate and the payment they have and they look at what it would cost them to get a similar house with maybe some more amenities or newer or bigger in a better area, the cost is so high that they're simply staying put. And this is one of the biggest challenges we've had since inflation started 2 years ago, and interest rates went up and everyone just decided, I'm not selling. Now, when we talk about today's interest rates, they're definitely higher than they were just a couple years ago. And I see articles out there and I hear people talk about it all the time. I remember when interest rates were 18%. Well, that comment kind of annoys me because when interest rates were 17, 18%, home prices were much lower than they are today, and wages were also much lower today. So one of the measurements that we use when it comes to helping people understand the true affordability of home ownership is what we call the affordability index. And this is going to take into consideration not just interest rates, not just home prices, but also wage growth. And the fact of the matter is that wage growth over the last 5 years has not even come close to keeping up with the prices of homes or interest rates, and that's why this number is so far out of whack. Now, the truth is there are still plenty of people buying homes today. I have clients buying homes in California and Florida and all kinds of other states, but generally it's people that have to move. They have life decisions and transitions in their life, like job transfer, they're getting married, they're getting divorced, or they simply are not affected by the affordability of where things are at today. Sure, everyone would love to get a better deal, but this is the reality that we've been in for an extended period of time. And everyone wants to ask the big question, when are prices going to come down? Well, to be honest with you, I think it's happening right now. Remember, when we think about what home prices are doing today, we're usually going to know what they were doing last month first, because what we're going to see is the pending home sales turn into closed purchases, which is going to reset values in any given neighborhood. And then we're going to start being able to put data out there that home prices are softening. Well, I will tell you that in most markets in America, that is happening right now. Many of our clients that are buying homes are getting up to $35,000. I had a client the other day in seller credits to get an interest rate that was less than 4% through a temporary buy down. And a lot of sellers right now are really trying to get aggressive and attracting buyers to their property. And what we're seeing, at least from my desk, is that it is slowly turning into more of a buyer's market. So if you're a home buyer or you're a home owner that would like to buy a property, I think it's really important that you start paying attention to what's happening right now. And the reason why is because when interest rates come down, which could happen at any point right now, I do believe that home prices are going to go up pretty fast, and most people that are watching this would probably come to that same conclusion. Freddie Mac recently released a second mortgage program. What this is going to do is help people that currently own a home get the ability to take some of that equity locked in their property out at an affordable interest rate. Now, traditionally, when someone wanted to take some of the equity out of their home, they would either get a home equity line of credit or they would do what's called a cash out refinance, which is where they would basically get a new first mortgage. But because of the locked-in effect and most people having a 3 or 4% or less, people aren't doing that. And if you look at the prospect of a home equity line of credit, those interest rates are tied mostly to the prime rate. So many people that look at a home equity line of credit today are going to be looking at a rate somewhere between 9 and 14%, which is not as affordable as it would have been just a couple years ago. So Freddie Mac, who has a mission to create affordable housing, thought that it would be a great idea if they could create a second mortgage so that someone could take money out of their property and have a low fixed rate and go up to a loan to value where they still have sufficient equity and they're not being put at risk. Well, this week, the Biden administration approved it, and we will start seeing this product in the coming weeks that we can offer to current homeowners. Now, the one thing that's happening out there is a lot of investors on Wall Street and some of the analysts are looking at this product and thinking that it's going to be predatory, and we're creating a 2008 scenario where it's irresponsible lending and people are going to borrow everything out of their property, go out and buy depreciating assets. And I don't really think that's the case. I looked at the guidelines today, and to be honest with you, I think for those people that have gotten themselves into credit card debt, would like to do some remodels to upgrade their house or get energy efficiency upgrades to lower the ever-increasing electricity bills that many places have, this could be a really good option for them. But we're going to have to take a look at it, and we will give you updates on that going forward. If you're someone that's thinking about real estate, if you're confused about this market, if you have questions on loan products, I am available to you. You can email me or call me by looking at the description of this video anytime. I do respond to all my comments and questions. I hope you and your family are enjoying your summer. And as always, please don't hesitate to reach out if there's anything I can do for you. Have a great day.